Hi, everyone, and and good afternoon, and welcome to LIBOR's Wednesday webinar. We'd like to start on time in respect for everybody's busy schedules. And I'm Mary Ann Monteleone, Vice President of Professional Development for LIBOR, and I'd like to introduce today's speaker, David Childers. David is president of Keeping Current Matters, or as we know it, KCM, and has kept his finger on the pulse of real estate industry for over 20 years. David regularly contributes the current industry and market insights through various webinars, podcasts, and videos with aim of helping real estate professionals establish themselves as their market's definitive go-to resource. So we're happy to have him back for a look at the housing market in 2022. Welcome, David.
Thanks, Marianne. We're excited to be back and grateful for the opportunity. You know, we've got a chance to do this a couple of times over the last years and through COVID, and so grateful for it. You know, it's always a special time when I get a chance to share with you, because KCM was started on Long Island. Many of you know that. The office in Ronkonkoma there, and Steve being from Long Island for so long, so many great relationships. And matter of fact, I was on the phone with Steve just a minute ago, and he said to say hello to everyone and told me not to screw it up. So that's my goal, is to give you really a look at the housing market this coming year. And we'll sort of do that in a different way this time, as I know folks are joining and getting on here. We're going to kind of go through a lot of the KCM data. And I'm going to do a couple of things different. I've got kind of three mini presentations, so to speak. Maybe we'll, take the next 45 minutes, 50 minutes, whatever it is, be respectful of your time. First, I'm going to kind of start out where the market is at right now. We're going to be talking about the macro U.S. real estate market across the world. We're not going to do a lot of deeper dives into local areas. We talked about that. There's just so many things kind of happening right now that I want to educate you on, that I think our time spent there is going to be very valuable. Then I'll kind of pause. Any questions there? Marianne and I may, have a quick conversation there. We'll come back on, and then we'll move into two areas that I think, agents that I see are struggling explaining to their clients. And I'm going to give you some visuals. I'm going to give you some words to explain interest rates and inflation and their impact on the market, so that you can give certainty to the clients you're serving. And then we'll kind of pause again, like I said, and we'll wrap up at the end talking about what to expect in the coming year. I have all the forecast, everything that you know and love about Keeping Current Matters, and equip you with that. I'm going to get all these slides after this over to Marianne, so she can get those to you. She'll tell you where those are housed and how you can download those and use these. If you maybe make a video, or you put some information out there on social media, or maybe you're sitting down at the dinner table with someone talking about, maybe we're thinking about selling our home, or we're thinking about buying right now, to educate them on the market. So we'll do that is, the next few minutes. And again, grateful to have everybody on here, grateful for your investment in time and trust over the next few minutes, and certainly a special part in all of our hearts here at Keeping Current Matters for everybody at LIBOR, and just our history together. So grateful for the support of LIBOR. When I think about Keeping Current Matters getting started 14 years ago, back in 2008, LIBOR and Marianne were some of the biggest supporters of what we do. So we're so grateful for that. So let's start off this. I'll start off with a quote here from Bill McBride, the founder of Calculated Risk, runs a blog and called the 2008 downturn. He says this: "It is possible that rising mortgage rates will slow the housing market, or the Fed might raise rates sooner than expected due to the recent pickup in inflation. But I believe one thing is certain: inventory will tell the tale." And I don't think there's a more appropriate message than that right now. Our business forever and will always be about inventory and generating listings. But if it's about that every year, then it's twice or 3 or 4 or 10 times more about that this year. We know over the last couple of years, COVID and everything that's happened has dwindled the supply of homes across the country. There's not too many folks that I talk to that don't say we need more inventory in the market right now. We have more buyers than we have inventory, and certainly is true across the country. The bad news, if that is listings are at record lows. You see this neighborhood here, and are there any homes for sale? And anything that does go for sale is going into some type of auction type scenario where you have more people that want to buy it than it's available to. We have literally more people that want to buy than available homes for sale. If you go across the country and look, we always want to look at all the different maps, and I'll kind of call out New York here, down 16.7% year over year. Nationally, down almost 27%. If you see that little number at the middle bottom of the screen there, all across the country, this map compares December of 2021 as compared to December of 2020, down almost 27%. And we know at the end of 2020, we were in a rough spot with listings across the country. And no doubt that continues on for a lot of reasons. And we've covered a lot of those reasons at Keeping Current Matters. If you've followed us or you're a subscriber, then you're well prepared for that conversation. But many people looking at the rise in prices and thinking, gosh, this is not going to end well. And I'm going to cover that at the end when we say what's going to happen this year. But no doubt we need more inventory. And that's sort of a known. I'm not telling you anything right now you don't know. But the next piece we want to look at is buyer activity. And the most recent buyer activities as of November, obviously we're here at the end of January, but going into the holidays, one thing is for certain, COVID or anything like that has not slowed buyers down. Maybe slowing some sellers down, maybe some people saying, I don't know if I want to bring people into my home right now, but no doubt it is not slowing buyers down. They're saying, we want to buy, we want to try to buy before interest rates go up any further. We've had needs that maybe we've put off, or we made a decision, we want to do something, and they are out in full force across the country. That's the name of the game right now. More buyers than there are listings. We need to generate listings. I do believe right now there's some very, very good news. And I think there's a lot of pent-up demand with listers, and listings are coming. So I want to cover that for a few minutes, and then I'm going to pause. I'm going to talk about where I think the biggest opportunity is. Then we'll come back on. I'll take some questions, and then we'll continue on. But first, I'll start here from NAR. It says the pandemic likely spurred occupants to shorten their home stay, as tenure in the home decreased from 8 years to 8 years from 10 years, according to the report. This is the largest single change in home tenure since NAR began collecting such data. If you're like me, you grew up in this business, and you knew that everybody, the average was somebody moved every 5 or 6 years. Certainly people would stay longer, some would stay shorter, but nationally the average is somebody would move that sort of time frame. Then the downturn comes in 2008, and people start staying in their homes longer. If you look at this graphically, this is what that looks like. The dark gray bars there, 1985 to 2008, average tenure about 6 years. And that's what most of us said, okay, yeah, we get that, we know that. That shifted post-housing crash. And a lot of reasons for that. People started staying in their homes 7 years, 8 years, 9 years, 10 years, because they didn't have an option. Either maybe they didn't have the equity to be able to parlay into another home. Maybe they were underwater. Maybe they saw somebody get hurt. So many reasons that we know caused people to stay in their homes longer. Now, what do we see in 2021? Pandemic comes along. People say we need something different in a home, and it's shifting downward. You go back to this quote right here, the largest single year change there in the dark letters in home tenure since NAR began collecting this data. Now, I'm not suggesting that 1 year makes a trend. It certainly does not, but I am suggesting this. There is pent-up seller demand out there right now for the past 10 years of folks that made a decision not to do something for a lot of good reasons, like we talked about, that I think we need to be engaging in. Oh, by the way, another study says this: the pandemic has delayed plans for many Americans, and homeowners looking to move on to the next stage of life are no exception. Recent survey data suggests the majority of prospective sellers are actively preparing to enter the market this winter. The first day of winter is towards the end of December. We're kind of a month into that, but this survey, and I'm going to show it to you in just a minute, reveals what sellers are thinking. Now, the impact of the coronavirus, I think it does delay some sellers. I think we're paying the price of that right now, folks saying, I don't know if I want to bring a bunch of people through my home right now with this uptick and everything. Let's all hope and pray and watch, hopefully these cases come down and we move through that. And that's certainly our expectation. I'm not here to try to bring an update on that, but that's the expectation, and those sellers will come out. Of those that are planning to list in the 6 months, coming out of that survey we just talked about, 65% have either just listed, or 19% just listed, or have plans to this winter. So an overwhelming majority saying, we're going to do something this winter. 36% have researched the value of a home in their neighborhood, or they saw their neighbors sell for this. They maybe started making repairs, decluttering, and they're wondering, okay, I think this could be our time. 93% have already taken steps to, move that direction, including maybe talking to someone. Maybe they're engaging with an agent. 28% there of that subset engaging with an agent. No doubt, we're seeing a world in real estate where there is pent-up demand, in many saying in the next 6 months we're going to list. So that sort of positions where is the opportunity to engage people right now around, is this the right time to list your home if you're thinking about it? The ones I want to talk to now are certainly some that say, I'm thinking about doing something in the next year or two. I want to educate them on the opportunity this market affords them. Coming from the most recent conference and expo from Realtor organization, the lack of insight around home equity presents an opportunity for real estate professionals who are always looking for touch points with past clients. Some people, depending on who you follow, so there's no such thing as a past client. We want to engage with every client. They're clients we've done business with in the past, but hopefully they don't become past clients. Equity is the number one area to connect with people on right now. If I was out in the market right now and making conversations, and Steve and I talk about a lot of this and his history and leading, the business for so long there on Long Island, about interfacing with people. Do you know how much your home is worth right now? Do you know how much equity you have in your home? And helping them, being an advisor to them to help them make a wise decision. Is it now a time to move up? Is it a time to downsize? Is there something they want to do with that equity? And we can help them do that. CoreLogic came out as of the third quarter, most recent data. The average home in this country grew in equity by $57,000. You literally have that conversation with someone, mention that statistic, and it is kind of a stopper. People are like, what? The average home in this country grew in wealth, in equity by $57,000. If you think about that, the average home, about $350,000, depending on where you're at, multiple of that, and could be, more in equity growth in somebody that you're talking with. 31.1%, that's the year-over-year increase in equity for U.S. mortgage holders. 3.2 trillion, that's the growth in total equity. There's tremendous equity in homes across the country. If you look at the map all across the country, New York, $49,000 on average in equity growth. And you can see, I included this map because I know you have a lot of clients that maybe are buying elsewhere or are looking, maybe want to make a decision, maybe we want to move somewhere, and you can give them that perspective on that market. If they're thinking about Florida, if they're thinking about, somewhere else that they want to move to, this just gives that education piece that, so many folks are wanting right now because they have questions about the market. We've come out of COVID, and I'm going to cover some of the forbearance things that KCM always keeps you up to date on in just a minute. But this will give them the understanding of equity across the country. I'll kind of wrap with this before I bring Mary Ann back up. First American says this: increasing home price appreciation may encourage existing homeowners to use that equity to purchase a larger and more attractive home, a dynamic known as the wealth effect of rising equity, which is already happening to some extent. Let me pause here. I'm going to take a look at questions that are out there. And Mary Ann, if you want to come back on, there was a question, can we get the slides for these? Absolutely. I'm going to give you these slides. I'm going to give them to Mary Ann. She'll let you know where you can download those from. And I want you to use these. Use these for anything that you're doing with a client. Maybe it's a listing presentation. Maybe you're, I think sometimes having some of these images on your phone when you're somewhere and somebody asks you a question that you can easily show them. And I'm not saying you're going to be somewhere and you're going to turn that into a listing presentation right there, but I'm saying you can show them, one of these particular visuals, maybe it's an equity visual, something like that, and say, let's sit down and let's talk about this. Let's schedule an appointment. Let's do something and let's look at your home. If it's equity and you say, hey, the average home in this country grew in equity by, $57,000. And then, let's sit down and talk about your home. What does that mean for you? Equity ultimately is going to be what's the home worth minus what do you owe? And a lot of people, I'll tell you right now, will be shocked in what their home is worth and the equity they have on there. Kimberly, I see your comment there. Having on the phone is a great idea. We see people doing that all the time, because we run into people know what we do, and we can have that conversation. Joanne, see your comment there. We will get the slides to you and get you to allow you to use those. So any other questions, drop them in there so that I can get those and see those. We love to post these on social media. I see that on there. Absolutely. Use these on social media. It's one of the things, if you notice, the slides that I use are in what they call 4:3 format versus the 16:9. So they're better for social media, and they fit the kind of square if you think about Instagram or Facebook or things like that. I'm not going to email. I'm going to send them to Marianne. She'll give you all the slides. Marianne, if you can tell folks where they can get these slides from. I don't know if you can.
Sure. We're going to host them on our site, and I'll put the address in the chat for everyone.
Perfect. Okay. So let's kind of go on. We're almost 20 minutes in here. Let's talk about a couple of areas that folks are struggling with right now in giving expert opinion. Their interest rates and inflation, two big topics that you just about can't turn on the news. You can't open a newspaper if people open newspapers much anymore. No doubt people do, but an app that you read news on your phone, all that, and hear about either one of these topics. Now, I'm not suggesting, let me be very clear as we start off here. I'm not suggesting that interest rates or inflation are going to be these massive obstacles for real estate this year. I don't believe that. I think they're going to be things we have to contend with and things that we need to be educated on. But here's what I am suggesting. When clients that you're dealing with, you're working with, hear about these things, they become concerned. And that concern is over, am I working with somebody that can, explain this to me and can give me the peace of mind that I'm not going to end up in a situation that I regret. We always say at KCM that in times of uncertainty, people follow the certain. And what I want to do is I want to give you a few graphics. I want to give you a few ideas to give people certainty that you have this under control. If you're not a KCM member, try kcm.com, start a free 14-day trial. You get all these slides and we'll keep you up to date, because I think we're going to see some choppiness between here and the spring market in interest rates, in inflation, in things that are happening in the world, and there's uncertainty that causes concern for clients. So let's start here. Mortgage rates continue to move up. Most recent average mortgage rate from Freddie Mac, 3.56 as of the end of last week. That'll be updated again this week. It says mortgage rates moved up as the 10-year U.S. Treasury yield rose. I'm going to come back to that in just a minute. And financial markets adjusted to anticipated changes in monetary policy that will combat inflation. Everything about the Fed, what's the Fed going to do? Inflation's high. We have a byproduct on the interest rate equation. As a result, higher mortgage rates, purchase demand is modestly waned in advance of the spring home buying season. However, supply remains near historic tight levels and home prices remain high, keeping the market competitive. No doubt this will be a competitive real estate market this year. It will be a market that I think maybe not the appreciation that we saw in the past 12 months, but strong appreciation. I'll show you what forecasters are saying and certainly give you my perspective on that. But no doubt, the headline that everybody sees is the Fed's going to raise rate. What we want to talk to people about is the Fed does not control mortgage rates. And I'm not suggesting you need to become an expert on home loan financing. You do need a great partner. So if you need a lender partner, now is the time to find them, because refinances are going away. I'll talk about that in a minute. But have a strong finance partner that people can work with in understanding what's going on. Now I'll give you a couple of visuals so you can give them that certainty. First one is, where do we stack up with 3.56% in the market? This is a look at mortgage rates going back to January of 2018. So you think about January 2018, 2019. All right, we get into 2020. We're starting to go up, call it knocking on the door of 5%, anywhere from 4 to 5% in that time, starting to come down. 2020 comes along, coronavirus pandemic hits, the Fed acts, and they can't control interest rates. They can only hope to influence them. And they do just that, and they influence interest rates lower. And you've heard me probably say it many times, the average impact of a new home built in this country, economically speaking, is $88,000. The average impact of an existing home selling is about half of that, about $44,000. That's commissions, that's the blinds, that's everything you buy when you move into a new house. We're going to put paint in this, we're going to do all the things we're going to do. It's economically stimulating to any local economy and national economy when people buy homes. That's why real estate drives the economy. That's why we always say in any downturn, the economy won't come back until real estate comes back. And what's been driving this economy? Real estate's been on fire the last couple of years. Large thanks to all the hard work that all of you have done in that. So where are we at with interest rates? We're about where we were when the pandemic started. If you kind of follow that line across, you see right at about the beginning of 2020, March of 2020, start of the pandemic, and we're in a range called 3.5%, about where we were when we started that. So yeah, the dip down of the pandemic, Fed influence is there. Those rates likely in the twos are in the rearview mirror. I don't know what to say to anybody that missed it. You don't get that, but you can still finance a home for 30 years at 3.5%. Very, very good financing. I know if I, talked to many of you on the call, the first home you bought was a much higher rate than that. So no doubt we're in a good spot. But what do we want to do? We want to show the clients we're working with, we understand that. We're on top of this. You may even say, I'm subscribed to a service that keeps me up to date on where interest rates are. And many folks going, hey, we want to buy now before they go even higher, because it's going to cost more. Homes are going to appreciate this year. Mortgage rates are going to go up. These are going to cost more. That's the reality. And maybe we don't want to, try to convince somebody to do something they don't want to do. But I would hate for somebody not to do something because they didn't understand the dynamics at play. If we keep on this track, Freddie Mac says this: as mortgage rates rise, we do expect some moderation in housing demand, causing house price growth to temper. However, the combination of a large number of entry-level home buyers facing a shortage of entry-level inventory of homes for sale should keep the housing market competitive. Again, saying that we will see a competitive housing market this year. This is the interesting point here. In 2022, we expect purchase originations to grow from 1.9 trillion in 2021 to 2.1 trillion in 2022. We're going to sell more homes. More homes are going to be financed into 2022 than in 2021. While refinance activity is anticipated to decrease from 2.7 trillion in 2021 to 1.2 trillion in 2022. Refinance volume for lenders will go away. And certainly for purchase business, that's a good thing. Anyway, the way a lender works is they've got a finite amount of capacity. They can close so many loans. They're closing a ton of refis. Challenges purchases. Now, a lot of lenders preference purchase over refi. We got to get this purchase done, but no doubt there have been borrowers, there have been transactions that have been, had a challenging time in the last year because of the refinance volume. That's going away. There have been those of you that I've talked to, literally been on webinars and had conversations with people of saying, how do we get in touch with our lender? Now is a great time to have that lender, build that relationship with that lender that you trust, that can help steward and navigate your clients through all of this. If we think about these rates and how they compare to, prior decades, this is a look at the average mortgage rate going all the way back to the 70s. We're at 3.5% right now, a better rate than what we saw in each of the previous 5 decades. Now, I'm going to go into the projections in just a minute. We're going to be knocking on the door of 4 here soon. I think by the end of the year, we're certainly going to be tied with where we were at in the 2010s. I'm not saying we're always going to be below that, but I am saying this, still in very, very good range for those seeking financing on the mortgage rate, and preferable mortgage rates. Even we go into the 4s, still really, really good rates looking for long-term financing. So that is the expert opinion. That's the opinion I'd want you to have. Some agents are looking at rates right now and their clients are going, they look like they're going up, and they're going, they are, and we'll see where they land. We certainly don't have a crystal ball. We can't tell people this is where rates are going to be by when, but we can say, I'm on top of it, and I want to educate you. I want to show you so you can make the best decision in your home buying experience. Okay, so let's talk about this. I'm going to go to one more thing on interest rates before I go to inflation. The original quote that I used there, I'll go back to it here real quick. Mortgage rates moved up again as the 10-year U.S. Treasury yield rose. Remember, I said the Fed does not control interest rates. If you want to know where interest rates are going, look at the 10-year Treasury. This is a look from the beginning of December through the 18th of this month. And you don't have to understand it and why does this work and all that. Just know that the Treasury is skyrocketing. The yield on the 10-year Treasury is skyrocketing. Why is this so important? This next slide that I'm going to give you is something that you're going to want to use, you're going to want to have on your phone, and it's for this reason right here. For almost 50 years, the 10-year Treasury, or the 30-year mortgage rate has moved in unison with the 10-year Treasury. They have almost this symbiotic relationship, up or down, wherever the 10-year Treasury rate's going, the 30-year mortgage rate is going as well. Now, our team is working on some projections from experts on where is the 10-year Treasury going so that we can be predictive, give you the information to say, okay, where are interest rates going? And I'm going to cover some projections here in just a minute. But no doubt, this is a big question when those thinking about buying right now, they're having a tough time maybe finding a place, they're concerned. They want to buy before it goes higher. They feel that. You can give them the confidence. Let me educate you and show you what's happening right there in interest rates. Again, get all these slides to you, use them however you see fit. The other piece there is inflation. And I would offer homeownership is one of the best hedges against inflation. And I want to give you that information right now. You just about can't turn on the news. You can't, talk to somebody. You can't even go to the grocery store without feeling the impacts of inflation. You can't fill up your car without feeling the impact of inflation. And many people wondering, okay, does that mean I should buy a home? I'm concerned. All the questions that come up when we feel this. There's a study put out that 2 things were true in this study. One, most Americans for the past 2 years are doing better today than they were 2 years ago. Most. I know there's some people that are having a challenging time coming out of COVID. They're on most people are doing well. The other truth about that study was most didn't feel that way. When inflation starts to rise, when you go to the grocery store and things start to cost more, when you go to the gas station, it starts to cost more. You start to get worried about, okay, where does this all end? And certainly people feel this way. What about home ownership? Real estate is one of the time-honored inflation hedges. It's a tangible asset, and those tend to hold their value when inflation reigns, unlike paper assets. More specifically, as prices rise, so do property values. It comes from Investopedia. What I want to give you too in this is some sources for you to give your clients and say, don't just trust what I'm saying. Let me show you what experts are saying right now. Real estate, hard tangible assets are hedges against inflation. Why is that? You always want to be in an inflationary economy, in assets, in investments that are going to outperform inflation. Now, this next slide is another slide that I think is a key one that you're going to want to use. Our team went back and looked all the way back to the 70s and said, how is housing performed against inflation? That's an important question right now that many people want to know. Let's look at this. If you look here, blue bar is the inflation rate on average throughout that time period, that decade. The green bar is the average home price appreciation throughout that decade. So in the 70s, home price appreciation outperformed inflation. In the 80s, kind of neck and neck. Actually, inflation just slightly over it, but right there with it. The 90s, home price appreciation's outperformed. 2000, slightly below. Now, there's a reason for that. We know what happened in the 2000s, and we can educate our clients about that. 2010s, and then 20 and 21, you see that. No doubt, when you start to look at that, you can say, okay, more times than not, housing has outperformed inflation. And in the times outside of a housing crash, which had crippled the entire economy, it's been neck and neck. Homeownership is a hedge against inflation. And I think this is a message that we need to be vocal about in our business right now, because there's certainly folks that are wondering about that, wondering, should I buy? How is that going to affect my purchase? It goes on to say in a study from Bankrate, a fixed rate mortgage allows you to maintain the biggest portion of housing expenses at the same time. Sure, property taxes will rise and other expenses may creep up, but your monthly housing payment remains the same. And that's certainly not the case if you're renting. Somebody that's renting right now, that's not the case. Rents are going to rise. As a matter of fact, our team went back and looked at what's the average rent increase each year as compared to the inflation rate. And rent increases, more times than not, are more than the inflation rate. Let's look at this graph right here. Blue line's core inflation rate. Green line is rental price appreciation. You can just look at it visually here. You see there's more rental price appreciation on the high side than there is core inflation. So, actually apartment rents are going up faster than inflation on average most years. A couple of years below that, but on average, it's definitely going up more than inflation is. And so you want to keep that in mind as folks are looking at, should we rent right now? Should we buy? What's the best decision? I'm going to rent and wait till the market cools off and all of that. Gosh, I think that's a problem right now. I don't see, it getting cheaper down the road. And so I think having the perspective that you will have is going to be beneficial for so many people. Allie Wolf says this: if you have cash and are expecting inflation, you want to think through where you can put your money so it does not lose value. Housing is commonly looked at as a good inflation hedge, especially with interest rates so low. Again, 3.5%, great interest rate. Housing is an effective hedge against inflation. You can lock in your payment today in today's dollars. Inflation happens, you still have a payment in today's dollars. That's the beauty of home ownership. That's the beauty of a fixed rate mortgage. And oh, by the way, you build equity with that. We talked about that equity just a moment ago. Some people still say right now, I'm not sure I should do this. I'm not sure. What if I buy and the market crashes? And we've covered that extensively at KCM. Many of you know that. Many of you have followed that and shared that information. Most recently, home price expectation survey that came out, cumulative house appreciation by 2026. Optimists say 62.5% growth by 2026. Pessimists say 23.7%. Middle's 43. Pick wherever you want to be. Take the worst case scenario with the pessimist, a lot of appreciation in homes between here and 2026. We always want to remind folks of that, because many people that aren't in our business, I'm going to pause here for a second again, and we want to educate them. If we weren't in the business, we might be having some of those thoughts. So I'll look at the Q&A, see if there are questions out there. I don't think we have any new questions. We are going to send the slides out. Mary Ann can respond when they'll be available. I'll have those over to her by the end of this, right when we get done. I'll email those to you, Mary Ann. One thing I do want to say, there's a question that comes up a lot of times in our business. Is there a correlation between rising interest rates and maybe home values, or home values going to go down, or transaction volume? We're going to sell less homes in a rising interest rate environment. I will tell you this, from a price standpoint, there is not a correlation between rising interest rates and falling home prices. We've done extensive work on that at KCM. You can go back and grab those. You can email me if you need some of that information, David at Keeping Current Matters. And then when you look at transaction volume, I will say, when we've been in markets like this, where we've seen a rate rise around 1%, which is what I think will end up being, if we were at 2 3/4 towards the end of last year, or in the last year, and we're going to be there or knocking on the door of 4, transaction volumes have maintained. You saw the quote that I mentioned from Freddie Mac. They expect the business to moderate. Okay, so that doesn't mean decrease. That doesn't mean we're going to lose value in homes. But a lot of people start to get concerned about that and have questions about that, and we can answer those. So if you don't have any questions on those, I will get into some of our. Let me check here our Q&A here. I will get into our projections for this year. Okay, and that's what right now. What many people are wondering: what's this year going to be like? What's coming up? Maybe it's folks who we're talking to in the office, or maybe it is people that we're working with that I mentioned before that say, well, I'm going to hold off. I'm going to let this market cool down. I'm going to let some of this stuff work itself out. I'm going to let all these foreclosures come to market, and then I'm going to hop in. So let's start to take a look at that. I don't think those things are happening. I don't think you're going to see a ton of foreclosures, and I'll kind of prove it to you. Do you know a book you recommend to understand the finance and real estate? One of the books that has come out, and I think one of the best out there in the world is Barry Habib. He runs an organization called MBS Highway. He just wrote a book called Money in the Streets. Now, I have not read that book, but Barry does a great job with that in response to that question in the book. So let me share my screen again here. We'll talk about projections. Where are we going in 2022? So to set this up, I think right now, what we need to have is an educated market perspective on what we see coming in the year based on facts. There are a lot of people in our business that are going to say, here's what I think is going to happen. Here's what's going to go on. And they're not based on facts. They're based on whatever they think or whatever they, assume. Let's have an educated market opinion based upon facts. Okay. So first one, mortgage rates, where are they heading? Well, this is Freddie Mac saying this is our projection going into the first quarter of next year, somewhere knocking on the door of 4%. What does this tell me? We've had this sharp rise here in January. January typically is a volatile year in finance and in the mortgage business, but don't expect that volatile rise to continue, but expect the trend to continue upward. Probably bouncing around, and that's going to happen, but somewhere in the neighborhood of 4% by the end of the year. Could we be there sooner? Sure. Could we be there a little bit after? Sure. In the ballpark there, we're heading up. It's going to cost more to finance a home as we go throughout the year, no doubt. Okay. What about prices? What about prices that in home price appreciation? Big question. We saw almost 20% appreciation this past year. What are forecasters saying about next year? About this year? Well, not next year. It's this year right now. Average of all these forecasters I've listed here, 5.1%. What I'm seeing right now is forecasters up level their forecast in the year. I think it's probably gonna be a little bit more than that. We'll see. It's all gonna be about inventory. It's all gonna be about demand, and we'll watch it. Want to be able to forecast pricing for wherever you're doing business. It's all about inventory. It's gonna be all about what's happening with that. One of the big questions at KCM that we looked at last year, and maybe some of you saw that, is this question as, has home price acceleration peaked? And on this graphic, I've put a question mark there saying, has it? We saw home price appreciation grow each month last year. This is a look going back to January of last year. And homes got, appreciation picked up steam just about each month going into the middle of the year last year, meaning, not only were homes costing more, they were at a faster rate each month. And then we sort of hit the fall, and they started to peak or plateau. And that's the question coming out of last year, seeing, 18, 19, 20% in homes across the country. What are we going to see this year? I just talked about what forecasters are forecasting for this year, but no doubt we've seen a ton of appreciation. Now, the big term that will be mentioned, and I think it'll be out there and clients will see it, is deceleration in pricing. And when people hear deceleration, they think depreciation. And deceleration and depreciation are two different things. First, let me be clear. I don't see anybody calling for depreciation in homes across the country. I do hear people saying homes will not appreciate as fast as they did last year. So the headline is going to say homes appreciated at this, but not as much as last year. Homes appreciated at this percentage, but not as much as last month. And people are going to go, okay, here's where this goes. It's not as much. We're on the way down. And that fear is going to kick in. And we've got to educate people and show them that price appreciation is cumulative. If prices go up by 20% 1 year and then 10% the next year, that's a good thing. That's not a bad thing. And oh, by the way, 10% appreciation in homes is historical. So the average appreciation in homes for the last 20 years has been about 3.8%. We've seen well above that over the last couple of years. So that gives you the education there. House prices and existing home sales have historically been resilient to rising mortgage rates. Big question coming out of First American. They're answering it here for us. The data just does not support the fact that interest rates are going to cause a problem for home sales or prices, okay? Let's talk for just a minute about those that are wondering, we're going to see a wave of foreclosures. They are still out there. I understand that. Thankfully, in the news, I think we're starting to hear more about it. I think the message is getting out there, but the forbearance update, which KCM for in the last year and a half, forbearances in this country are finally below 1 million active mortgages. About 780,000 mortgages in forbearance. That's way off the high of May of 2020, where you see the peak on the left side of almost 5 million mortgages in forbearance. People are coming off there, and they're largely a non-issue. Now, I'm going to talk about the breakdown of what's happening to those people in just a minute, but this is a good thing. We want to see more and more people come off of forbearance, not needed. Right here, Black Knight, that publishes this data, says as the COVID-19 pandemic continues to create uncertainty in the global economy, the overwhelming majority, 89%, of single-family homeowners who sought financial assistance through COVID-related mortgage payments and forbearance plans have exited those plans. Overwhelming majority have exited those plans. If you remember, the narrative as we started this was everybody's going to go into forbearance and every one of them is going to turn into a foreclosure, because if you couldn't make your payments during that time, how do you expect somebody to catch up? Certainly 6 or 12 months of payments. We know the cure rate on 90-day defaults, very, very low. You go 90 days behind on your payments, you're going into foreclosure. That's traditionally how our business worked. Not this time with forbearance. Let's look at those that have come off. This is a look at loans exiting the forbearance program going all the way back to the middle of 2020, when people first started coming off of forbearance, until 12/31/2021, just less than a month ago, the last published data on this. The green section of the pie, 38% were paid in full. They either made their monthly payments, they paid it off the loan through a sale or paid it off, or their past due payments were brought current. Now, I don't think these people took forbearance incorrectly. I think these were people that said, I don't know what tomorrow is going to hold, and I'm going to go ahead and take it just in case. They got through it. They said we didn't need it. They were whole. 38%. You don't hear that when you turn on the news at night. 43.7% were worked out or had a repayment plan. 14.6 of that, you see it in the blue section there, the modifications or loan deferrals. They either said, hey, through a rate and term refinance, we're going to modify your loan. The loan deferral, they tacked it on the back end of the loan. We've heard about that certainly in those cases. But overwhelmingly, banks are in the posture to say, how do we work this out? How do we help you? How do we help you get through this? We can't get through this. How do we help you sell it? We don't want to foreclose on it. Back in the housing crisis, I worked for the bank that was the #1 owner of distressed assets, REO properties in the country. And I can guarantee you, they didn't want that again. They would do everything in their power to avoid what happened in the housing crisis, so that they didn't have to deal with that. About bankrupted all these banks, and they said, we'll do anything to work through this, and you're seeing it. 4 out of 5 of the people coming off of forbearance either didn't need it or went through a workout. I'm not saying none of those aren't going to have trouble, because certainly they will, but it's not the overwhelming majority. 18.2 are still those in trouble. Maybe they don't have a loss mitigation plan. Maybe they're in a short sale or some type of deed in lieu, type of situation. Bottom line today is people have options. They have options through the amount of equity they have in their homes. They have options through the way banks are handling this. Certainly you may know somebody who's going through that, who may need to sell their home. And hopefully today they can sell their home, have a little bit more money, pay off the mortgage, the lien on the home, put a little bit of money in their pocket, pay commission, do whatever they need to do, and get to the other side of the crisis they and their family are facing. And that's an option that's available today that wasn't an option back in 2008. So if you think about this, CoreLogic says this: as we look forward, we may see a little bit of an uptick in foreclosure rates in 2022, but just an uptick from an extraordinarily low level, and we're not expecting to see a big increase. We expect delinquency rates overall on home mortgages to actually continue to remain quite low. I'll read that again. We expect them to actually continue to remain quite low. What's CoreLogic saying? What are the folks that have all the access to the data, all the access to all this information? They're saying we expect the foreclosure rate, the delinquency rate to remain quite low. A lot of reasons for that. A lot of reasons that stack up to equity, a lot of reasons that stack up to lending standards today, all of those things that we know to be true. If you have somebody that is waiting on all the foreclosures, you may want to share this with them, because I don't know that those are coming. I think we need to be the educators in this spot. I'll wrap with this. It says, so overall, I do think 2022 will be another strong year in housing. Albeit a little bit higher mortgage rates, we do think sales will continue to rise and actually reach a 16-year high in 2022. Right now, our job, no doubt, is to be out there, is to be having conversations. I think the only thing that stands between us and having a great year is what we're going to do about it. You know, at KCM, we want to be your partner. If you haven't tried KCM, you can go to trykcm.com, start a free 14-day trial. We give you all of this for $29 a month. Love to have you have access to this, so you have these graphs between here and the spring market. They're going to be important. People are going to have questions, no doubt, and we want you to have the best answers to those questions for the clients you serve. So, Marianne, I'm always grateful to get a chance to spend time with you and everybody on here at LIBOR. If you want to come back on, certainly do that. I'll take a look and see if there are questions. I don't know if you have questions. There's one about forbearance, but go ahead. I'll look here real quick.
Okay. We do have a few. Are you in the Q&A?
I'm looking at it right now. Yeah.
Okay, great.
Yeah. So let me go through these. AJ asked, what is forbearance? So forbearance was the tool given to homeowners to help weather the storm relative to their payments. You think about this, the servicer, the federal government came out and said, if somebody needs forbearance, meaning that they're having a hardship going through COVID, they can apply to forbear their payments, meaning they don't have to make them. Okay. And so that's what forbearance has been. It's never been done before in this country. I mean, forbearance has been around, but it never on this wide scale, because if you remember back then, there are two things they said: you have to apply for it and you will receive it. That was the only qualification for it. Apply for it and you will receive it. These people did, and they're coming off, and we're not seeing those issues, but that is forbearance. How does low inventory affect the market in 2022? I think there's a lot of pent-up demand, and we're going to have to see that, how that materializes listings. Low inventory will affect the market this way, like it has in the last 2 years. If inventory remains low, prices will continue to rise. We see more inventory coming into the market, that will moderate pricing. But you want to know what's going to happen with pricing. You want to know what's going to happen, in the future. Look at inventory. You have clients that are concerned about prices and go, gosh, homes are appreciating so fast. This doesn't feel like it's going to end well. You have to educate them. That is a direct, relationship to the amount of inventory available and the number of people that want to buy. It's simple economics. What happens anytime you have something to sell and you have more people that want to buy it than you have available inventory? The price goes up, and that's how that will affect the market this year. Let's see.
A few questions in the Q&A too, David.
Yep, I'm looking at this.
Okay.
Andrea says, I'm an agent out on Hamptons, Long Island. Just to confirm, you're saying that if mortgage rates go up, you don't think it will affect pricing of homes. I'm saying this, Andrea. There is no historical evidence that there is a correlation between a rising rate environment and decreasing prices. Or depreciation in homes. Okay. If you want to email me, I can show you that historical information. It's just David at Keeping Current Matters, but that's what the data suggests. You go back to that quote. There's not a correlation between that in the market, but it is what a lot of people think. The margin from list to offer will decrease, ? I'm not sure, Jan, on what that is, but more inventory probably is going to help the gap between margin from list to offer. How does the age of the population affect the market? Baby boomers are retiring, Gen Z are having families, etc. No doubt, Kimberly, the biggest piece of the market right now is millennials. They are the biggest buying subset, the largest generation behind baby boomers that we have, and they are dominating the purchase market across the country. Certainly baby boomers are retiring. I think there are a lot of people that, through the pandemic have said, we might do something in a couple of years, or we're going to move somewhere when they're retiring, and they're thinking we're going to go ahead and do that. Maybe they can work remotely. People are working longer these days, but I think it's causing people to make different decisions. Keith, I see that. Thank you for that. It's always fun to be with everybody. Jennifer, let me read your quote here. I'm a new agent. Can you please go over again? I keep hearing people say as homeowners come off of forbearance, we're going to see a lot more foreclosures. Can you speak to this again? Jennifer, I see that. And again, you can, if you want to email me, I can send this to you, but I'll bring that slide back up and I'll show that to you. So Jennifer, this is a slide that I always go over in this. So if somebody were to say to me, hey, this isn't going to end well. When all these people come off of forbearance, they're going to end up in foreclosures. My question back there would be, what do you base that on? You seem passionate about that, and I just want to listen. Tell me why you feel that way. And I think a lot of people just go, because if somebody can't make their payment, how are they not going to end up in a foreclosure? Which makes complete sense. I'm not arguing that. What I am telling you is this is from the Mortgage Bankers Association. Everybody that's coming off of forbearance, what's happened to them? And like I said, 4 out of 5 either went through a workout with their bank, or they paid off, or they were whole. They paid off the mortgage or paid the back payments, whatever it is. Very, very, very small sliver. Oh, by the way, if you go back to the other slide that I used, 5 million at the height, under 1 million right now, 4 million homes that have come off of forbearance. My question would be, have you seen any of those go into foreclosure? And you haven't. The interesting thing is this thought is not a foreign thought. When we went through 2008, everybody saw that happen. So what happens? Let's take simple psychology. You go out and you get bit by a dog. The next time you see that dog, you go, I don't know. Doesn't mean that dog's ferocious, doesn't mean that dog's going to bite you, but you're remembering what happened last time. And that's certainly how our bodies and our minds are wired to work. And it's no different in housing. People are saying, I saw how this went last time. I see everything that's happening. This doesn't make sense. We're going to end up in a bad spot. It's certainly not true. Back in 2008, there wasn't forbearance. There wasn't the tools. Again, I told you, banks don't want that again. They're super motivated to not have that happen. And so I think it's important that we have that conversation, that we have the facts to be able to talk through that. The interesting thing, if you look at for the last several years prior to COVID, about 250, 275,000 foreclosures each year in this country. Last 2 years, we've seen dramatically lower numbers than that because of moratoriums. And in that, it's almost unfathomable to think about that. 275,000 each year, far less than that last couple of years because of eviction moratoriums and all that. The third thing is, back in the crisis, over 9 million people went into foreclosure during the housing crisis. Massive number. And you saw what CoreLogic said. We expect this year that to remain quite low. I'm going to read your comment here. Thank you. I get it now. I was being distracted by my kids before. I see that. Totally get that, Jennifer. Do you think a lot of foreclosures are going to happen, and how long before it happens? I heard there's a delay of 2 years to finally go through foreclosure. I don't see it. It's not in the numbers that are being published. I have heard asset managers that are reaching out to people saying, get ready for foreclosures that are coming on. It's just not materializing. So there's nothing in any of the information that suggests that that's going to happen. The bigger issue is people that are waiting around for it. I think they're going to be disappointed. So I don't see any more questions. If you have other questions, I'm certainly happy to hang around for those. Dina says, please give us the website to get the slides. I think Marianne put that in there.
I just did again.
Perfect.
It's lirealtor.com/education, and then the drop-down box will say Wednesday webinars, and we'll put that there for everyone.
Perfect. Marianne,
I
I'll send these to you right as soon as we hang up here, so you have it. You can get them to everybody. Use these slides. That's my only ask. Use them in people you're talking to. Use them on your social media post, whatever it is. Know that from everybody at KCM, we are big fans of everything LIBOR does, big fans of Marianne. Whenever we can do this, Marianne, we love being on, and thank you for the invitation.
Thank you so much. And based on the questions, I think we're just going to have you back.
For sure. Sounds good to me.
Thank you, everyone. Have a good day.
Take care. Bye-bye.